Okay, let's continue the transaction analysis of available for sales securities. As we discussed during the class, again, the available for sales is not classified in trading securities nor the held to maturity securities. That's why it can be reported in the current asset or a non-current asset in the balance sheet. We follow exactly the same way as trading securities and the valuation, which is the fair value option. But a main distinction between the trading securities and available for sales securities is that we are using a temporary account of other comprehensive income (OCI) under the net income. It is not included in the net income, but after net income, because we are not sure whether to sell the stock in the near future or in the long term, right? We haven't decided yet. That's why we are using this other comprehensive income. And then that other comprehensive income account is going to be accumulated into accumulated other comprehensive income account. Interest, dividend, and dividend income is exactly the same way to record on the net income as the trading securities. And then all the cash flows generated by this available for sales securities is investing cash flows. Let's go. All the descriptions are the same, right? Except for the judgment of the intended purchase of this investment. So here, when the company purchased, right, the available for sales securities, now $100,000, and then cash, exactly same amount, and then the company received cash for the dividend, 4,000, asset up, and then that is the revenue, right? But it is not dividend revenue first. But it's not their main activities. So it is other revenue part. Fiscal year end, based on the fair value option, we put value $110,000 of Intel stock by increasing only 10,000, right? So that AFS is updated $110,000 on the book value as of September 30th, right? And then here, the point is here, OCI, other comprehensive income account, right? Because the increase of this $10,000 from original cost of this available for sales stock is unrealized gain. Unrealized gain cannot be recorded on the net income because available for sales securities, in the available for sales securities, the company hasn't decided whether to sell the stock or not in the near future or in the long term, right? That's why they cannot decide in that year net income. Instead, all this unrealized gain or loss will be recorded in the separate a temporary account of other comprehensive income on the income statement, and then is accumulated into the accumulated other comprehensive income account. Okay, so let's record AFSS $100,000 original cost, cash out, and then cash up when the company received the dividend. Then dividend is right actual business activity for reported income in the other revenue, and then AFS increased by 10,000, right? And then here is the point. We do not put this gain on here in the net income, right? Instead, after net income, we do not count this net income, and we don't want to count this unrealized gain as the net income and then retain the earning because it is uncertain. It can be like short-term income or long-term income. So we cannot put this value on the fiscal year of 2016. But the trading securities is different. Whenever we want to sell, we will sell this stock in a very short term, right? So we just recorded this gain on the income statement under the net income, in the net income. But here, other comprehensive income, just 10,000. Then let's just record, connect this income statement account on the balance sheet. So here, the net income, if there is no other transaction, then total comprehensive income, which is net income plus other comprehensive income. Now let's link only net income on the retained earning, and then the same function of this the accumulated other comprehensive income is to collect this other comprehensive income, which is unrealized gain, $10,000 into the balance, exactly same way. September 30, 2017, at the end of the fiscal year end, the fair value of Apple's investment in Intel's stock is now $105,000. Exactly same way. How do we reduce? Based on the fair value option, right? AFSS. Here, how much do you want to reduce? 5,000, right? From 110,000 to 5,000. Here we also use OCI. Now this is unrealized, now loss, right? This is unrealized loss. Okay, before selling, until the company sells the stock, it goes up and down every fiscal end, the following the fair value option. If the price goes up from the ending balance of the prior year, then we increase the OCI. If it decreased, then OCI decreased. Why do we record OCI on the debit side? Because OCI is the equity account, right? Equity account. If equity decreases, we put on the debit. If the equity increases, we put this on the credit. Every account must be started from the ending balance of last year, right? Because that is the beginning balance of the current year. So that is the starting point. Okay. So we put OCI and AFSS. Let's put the credit first. $5,000 decreased, and other comprehensive income, not here, but other comprehensive income there. Now this is minus, right? So the total, the comprehensive income, if there's no other transaction, then it is minus $5,000. Now this AOCI must be now reduced by this other comprehensive income. Got it? Then we balance that out. So as you can see, this AOCI $5,000 is unrealized gain cumulative, right? We increased unrealized gain 10,000 and decreased unrealized loss 5,000 in the accumulated other comprehensive income. We increased here prior year and the current year 5,000, right? Then exactly this $5,000 explains the difference between original cost of $100,000 investment, initial cost, and the book value or the market value at the end of the fiscal year 2017, right? And then never put this $5,000 under this AFSS, available for sales and security, because it is uncertain yet. It is uncertain. They don't know. They haven't decided whether to hold or sell this stock in the near term or even long term, right? That's why we cannot put this retained earning kind of a certain amount. And finally, they sold. This part is most the important transaction here. Now received cash 107,000, and then AFSS. How much? Right, the prior balance, ending balance, right? We need to remove this at $105,000, not $107,000. Right? we need to remove this book value of the prior balance, 105,000. Okay, then this is one of the point here. I will remove AOCI because AOCI, the unrealized gain $5,000 is no longer unrealized gain because the company sold the stock, right? This must be now $5,000, the ending balance of the prior year. And then, okay, we have to put, you have to decide that if the company realized the gain or not, right? How, or realized the gain or realized the loss. Yeah, $107,000 is the selling price, but the original cost was $100,000, right? So that must be realized gain. How much? Okay, realized gain. How much is that? 107 minus 100,000, right? Or you can just the plug in, which is the difference between the debit balance, sum of debit balance and the credit balance, right? Okay. Yeah, pretty the simple. And then here cash starting point always. Okay, let's get started from then on. The cash up because the company sold the stock, and then AFSS must be now 0, removed, right? And AOCI, we are not put this OCI 5,000 here, other comprehensive income. There's no longer the unrealized gain or unrealized loss, right? We directly reduce this AOCI 5,000 because it's no longer unrealized gain. Now this realized gain, finally we put in the net income, right? In the net income, 7,000. So net income 7,000, and then other comprehensive income 0 is not 5,000, it's 0. And then comprehensive income is 7,000. Then this 7,000 is only included on the equity. So we balanced out. You understood, right? So retained earning at the end of the day, when they sell in the same condition, comparing these trading securities, $11,000 are the same, right? Are the same. But as you can see, this net income of the first year in the trading securities, 14,000, right? But the net income in the available for sales security case is only $4,000 because that $10,000 is set aside, it's separately recorded in the temporary account of accumulated other comprehensive income because they haven't decided whether to sell the stock in the near term or not, right? It's still updated on the other comprehensive income by the other comprehensive income and the accumulated other comprehensive income, right? But finally, when the company sold the stock, then the 7,000. So this is really important clue when it comes to investment. If the company has like the other comprehensive accumulated other comprehensive income account on their balance sheet, that means that there is a chance sooner or later they can put this $5,000 into retained earning, right? Or there is some chance, some hidden unrealized gain turns to the realized gain sooner or later. That increase the net income. If the company increases net income in a specific period or year, that stock price can increase, right? For example, let me just open this is Apple company, Apple stock. Okay, do you see the accumulated other companies income? Okay, this $163 billion has a possibility to turn into the net income as a realized gain, for example. Okay. Then there is other some information if you take a look at this. Okay, net income. Under the net income, we have this the statement of operation, or the income statement. The bottom line is net income, but this bottom line of net income is continued by the other comprehensive income, right? And then do you see the changes in unrealized gain? Okay, wow, there are a lot of changes in fair value of market debt securities, or the investment here, right? So when it comes to the investment interpretation or some investment opportunity, the investors can use this information very professional way. Okay, so you guys, very good job. I'll see you in the next video clip. Bye bye.